Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillah wassalatu wassalamu ala rasulillah wa ala alihi wa sahbihi ajma'in. Dear brothers and sisters, this week inshallah we'll discuss chapter 3, which is the regulatory framework for credit. So in this chapter we'll see what are the regulatory bodies and what are the regulations related to credit, and why we actually need regulation for credit. Okay, so first of all, what is the goal of regulation in both for conventional and Islamic banking system? Do we really need to have regulation? Yes, we need, because of the protection of the depositors. So the depositors who put their money in in the banks, Islamic banks, so they should get some kind of assurance that their deposits are protected. So that's why the Islamic banks and conventional banks, they are required to mitigate the any risk related to financing, especially the credit risk. And then monetary and financial stability. So in order to make sure there is no financial the crash, there's no bank run, so banks need to maintain certain rules and regulation. And also for for efficient for efficiency of the financial system, and also to make sure there is a healthy competition among the banks. Recently we can see there are some merger and acquisition among the banks. So this was just to create efficiency, so that the banking institutions, they can reduce the cost and improve their services. So it is very important to have a healthy competition among the financial institutions, so that they can give better service to their clients. And also and then efficient allocation of credit is also the regulation needs to make sure that no sector of a society is ignored. Okay, all of the different segments of the society, um, they have the opportunity to get credit. And finally, ensuring a safe and secure banking system. So this is in order to make sure this system is safe, because it is it's a finance. So of course it has a lot of significance and importance. So in order to make sure the system is safe, people can transact their money, okay, without any problem, any spam and so on, and it is secure. So all in order to fulfill all these goals, there needs a regulation. Okay, the first and foremost important thing is the trust of the depositors. People, in order to make sure people have trust on the financial system, on the banking system. So first we need to look at the very important concept, which is called credit risk. Okay, so what is this credit risk? It is very important. It is okay. That credit risk is the risk, okay, that a borrower who borrows money from a financial institution, he may not pay back. Okay, so the same risk may also apply to Islamic banks, where a person who borrows money based on maybe murabaha or any kind, or ijara, so there is a possibility or risk that the person may not fulfill his commitment. So that is the credit risk. So this is the probability of loss from a debtor's default. It is also called a credit exposure. So the banks needs so this credit risk, of course, it is inevitable, and we cannot eliminate the risk there. But what we can the financial institutions, they are required to do is they need to measure, and then they need to mitigate this credit risk. So in order to mitigate the credit risk, what they do, Okay, usually they will measure first the risk. Okay, so how to measure the credit risk. So in order to how to calculate the credit risk, in order to assess the credit risk, the financial institutions, what they will do, they look for the the 5 C's. So here comes the credit assessment, credit scoring. 5 C are we will learn in the next chapter. Like they will look at the capacity of the borrower, whether the borrower is really has the capacity to pay back, or they look at the character of the borrower, whether the character of the borrower is fine, whether he has the willingness to pay. Okay, or they will may see the condition of the whether there is any economic situation or anything can affect the borrower, or what kind of collateral the borrower is offering. So all these are the things that they will measure. So this subject, the credit management or the financing analysis, exists because of this the assessment of the credit risk before. So it is required for all the Islamic banks and the conventional banks to mitigate the credit risk in order to protect the money of the depositors. So that's why they need to do the credit scoring, or they need to assess the credit risk of the clients. So and then if based on the rule of finance, higher risk, higher return. So if there is a higher level of perceived credit risk, so lenders may demand a higher rate of interest for their capital. So if a customer is risky customer, so he may need to pay more in terms of interest or profit. Okay, so how to mitigate this credit risk? Okay, so the banks, they need to uh, take some kind of measures. One of them to do the proper credit scoring, so that they can mitigate the risk according to the IFSB, Islamic Financial Services Board. Okay, which is one of the regulators for Islamic financial institutions. It said that Islamic banks should have in place appropriate methodologies for measuring and reporting the credit risk exposures arising under each Islamic financing instrument. So Islamic banks, they need to measure their risk against each type of financing they provide. For example, home financing based on BBA or Musharaka. So they need to measure the risk, and then against that risk, actually they are required to put some kind of reserve. Okay, or we can say that is a backup to mitigate the credit risk. Okay, so, the credit risk management policy of a financial institution directly reflects on its lending and financing assessment techniques. So, some banks we see they are very strict to give financing, while some are very flexible. So, why they do so? Because of their policy. If they take a if their management takes a very strict policy to mitigate their credit risk, so they might be the bank might be very strict to give financing. While if the management takes a flexible policy to mitigate their credit risk, so they might be very flexible to give financing to their uh, customers. Okay, so now after the credit risk, when we understand the credit risk and why credit risk is important, and why banks needs to do assessment because to mitigate the credit risk. And then one important thing is also related to the borrowing and lending practices of the bank is the monetary policy. Of course, this is a macro kind of thing. Okay, so this monetary policy is a process which is usually taken by the central bank of the country. Like in Malaysia, we have Bank Negara, or in US, if I'm not mistaken, like Federal Reserve. So they take this is a process to actually to control the supply of money. Okay, and also to ensure that the inflation rate is in check, and also the employment rate, and then also the stability of the country. So the central bank will take a different kind of tools or instrument to implement their monetary policy. So usually in the conventional finance, they have three types of instrument usually to practice to implement their monetary policy. One is the open market operations, where so this open market operation is where the central bank will openly buy and sell securities just to control the supply of money. Okay, to be clear, when the central bank wants to put money, okay, when the central bank wants to uh, pump in money in the economy, so what the central bank will do, they will sell the securities. Okay, the government securities, they will sell it. They will take back the money from the economy. They will sell security, and they will so that way they will okay, pump in the money in the economy. But when they want to take out the money from the economy, so at that time they will issue the securities. Okay, they will issue bonds, so people will buy their bonds, so people will pay the money to the central bank. So with that, the money will be taken out from the economy. Okay, which is opposite to the other way, when the central bank wants to uh, pump in money. So at that time, the government will just sell their the securities. Okay, and then another tool is the reserve requirement, which is okay, there are different types of reserve requirements. So usually the central bank, they will require every financial institution to keep some reserve in the vault. Okay, so why is it? Because to maintain to keep the system safe, and also to control the supply of money. So they have different types of reserve, like liquidity reserve requirement, or capital adequacy ratio, that we'll talk afterwards. So when the financial institution, when they get deposit, they are not allowed to use all the deposit for financing. They need to keep some money as reserve. This is to protect the system, so that there's no bank run, and also to control the supply of money. And then for another important thing is the discount rate, which is actually the interest rate or the cost of borrowing. So when the central bank wants to control the supply of money, they want to reduce the supply, so they will increase the interest rate, so that it will be difficult for people to borrow. At the same time, when they want to increase the supply of money, at that point the central bank will decrease the interest rate. So we can see right now, okay, the central bank reduce actually the discount rate. In Malaysia, we call it the base rate, which is the actually the basic rate for charging the interest for any borrowing. So that's the three tool for the central bank to control to implement the monetary policy. So what this monetary so with this, I think some of you may have understood why is it related to credit. Okay, so here there are two types of monetary policy. One is the expansionary monetary policy, where the central bank aims to increase the supply of money, where okay, they target to have increase the inflation. Okay, so at that time they will loosen the restrictions. And the opposite to it is the contractionary monetary policy, where they will decrease the money supply. Okay, so how they do it? They use So when they take the contractionary monetary policy, they will increase the interest rate. They will increase the reserve requirement for the banks. They will ask the banks to keep more reserve from their deposits. So when they and then as a consequence, the banks also will depress borrowing. They will tighten their giving loans to people, and with that, the spending by the consumers and businesses will be reduced. And when the central bank will take expansionary monetary policy, at that time they will decrease the interest rate. They will decrease the reserve requirements. So it will boost the borrowing. It will be cheap to borrow, so that businesses will be able to borrow easily. They can hire more individual people, so the employment okay, the unemployment rate will reduce. So this is how the it works. Okay, so usually, so right now we can see the Malaysian government is taking the expansionary monetary policy. So this the macro level policy, it actually has an impact on the bank's borrowing and lending. So when the government will take contractionary monetary policy, so the banks, they will tighten their policy, and they will reduce the number of loans. When the central bank will take expansionary monetary policy, then at that point the banks, they will reduce the requirements. They will be flexible, and they will increase the number of loans that they give. Okay, so we just talk about the reserve requirement. So one of the reserve is called statutory reserve requirement, which is very important. All the financial institutions in Malaysia, they must keep some okay, as a statutory reserve requirement with Bank Negara Malaysia. Okay, so any increment in the SRR ratio will decrease the lending ability of the banking institutions, and any decrement in the SRR ratio will increase the lending ability of the banking institutions. So with this, the Bank Negara can directly, uh, implement their policy. Whether if the Bank Negara wants to tighten the system, they will increase the SRR ratio. If they want to reduce it, if they want to loosen, they want take if they take expansionary policy, they will just reduce the SRR ratio. Okay, if I'm not mistaken, it is, I think, 2 to around 3%. Okay, that's the financial institutions, they need to keep with the Bank Negara. And then there is another one which is very more important than the SRR, which is capital adequacy ratio, and this is it is an international requirement. All the financial institutions in the world, those who are the Basel committees, okay, Basel committees supervision, they must maintain, okay, a minimum requirement of 8% of the capital adequacy. So all the banks, or whatever the loans, or we can say the financing they give against that finance, so that financing will be given a weightage. Okay, how we give weightage is like, if the banks give loan to the retail customer, is a normal customer, so it is given 100% risk weightage, because the risk is heavy. If the bank gives loan to a corporate customer, the weightage may be 50%. If the bank gives loan to the government, so it is 0%, because government is risk free. Okay, so with that, whatever the loans the banks give, so that will be given a weightage based on the percentage of risk. So after that, that risk weighted assets will be divided against the two types of the bank's capital. Okay, first is the tier 1 capital, and the second one is the tier 2 capital. So tier 1 capital is the very is a capital that the bank needs to stop their business in order to get the tier 1 capital, like their office, okay, or their system, okay, So that is the tier 1 capital. Tier 2 capital is a capital where the banks, they don't need to stop their operation. Okay, so they need to add up their tier 1 and tier 2 capital. So that's should be and then from that tier 1 and tier 2 capital, 80% of it they must always maintain. That is we call CAR, or capital adequacy ratio. For Islamic banks, actually, because their risk is higher than conventional, they are actually recommended to have more than 8%. I think it is 17% that the Islamic financial institutions to keep as a reserve. So why we need to keep this reserve? Because this capital adequacy ratio, especially after the financial crisis in 2008. Okay, the Basel Committee, they met in Basel, okay, in Europe. So they decided that the banks must maintain at least 8%, okay, as a reserve. Okay, and all the central banks of the world, they follow the Basel Committee's rules and regulation. Okay, so with this requirement for Islamic financial institutions, there is another important element, which is the Sharia Supervisory Board, that when they give credit or give financing, or along with following all these rules, they also need to follow the Sharia Supervisory Board. So we discuss in detail what is the Sharia Supervisory Board in another course, which is the Sharia aspect of business. So in short, this Sharia Supervisory Board is a regulatory body that will oversee and supervise the whether the bank's activities are in line with the Sharia or not. And in Malaysia, there are two layers of Sharia supervision. Each Islamic financial institution, they have they has a Sharia committee, and then at the national level, in Bank Negara, they have Sharia Advisory Council, okay, that supervises all the Islamic financial institutions in the country. So for any Islamic bank, they must follow this procedure when they want to introduce a new type of financing product, any car financing or any new kind of product, okay, or even an existing product, they must get the approval. Okay, so first, if the so at first the Sharia committee of the respected bank, they will see the product, and if that product is a existing product, means it is already used before and it is allowed by the Sharia Advisory Council of Bank Negara, so they will just approve it. However, if the product is a new and it is a like variation from the previous one, so the Sharia committee of that bank needs to refer to the Sharia Advisory Council of Bank Negara Malaysia to get the approval. And then if there is any violation of Sharia, the bank must inform it to the Bank Negara Sharia Advisory Council within a date. And and we have learned, okay, in Malaysia, this is very strict. Okay, a financial institution may be fined up to 25 million or even the 8 years of jail if they violate the Sharia principles. Okay, so when following the Sharia principles in Malaysia, it is mandatory for all financial institutions to follow the Sharia Advisory Council of Bank Negara Malaysia. But other than that, there are two international regulatory bodies which are AUFI, Accounting and Auditing Organization for Islamic Financial Institutions, and also the OIC Fiqh Academy, International Islamic Fiqh Academy under the OIC, Organization of Islamic Cooperation. So these two bodies are highly respected because we believe they have the highest authority in to decide on Sharia status on certain Sharia issues in Islamic financial products. Even though they are not mandatory, but they are highly respected, and many of even Bank Negara Sharia standards are actually based on initially from AOFI and OIC standards, and they sometimes there is a reputational risk, like when Bank Negara they allow by Ulina or by Uddain, so it triggered issues and reputation of Malaysia when, because it goes against the AOFI and OIC FIC Academy, and they are highly respected. So sometimes if Malaysian banks they do not follow them, they may also face challenges in especially when they want to attract international customers. Okay, so with that international with that Sharia, we need to know, okay, that there are certain professional bodies and international regulatory bodies that Islamic financial institutions need to follow. The first is the Basel Committee on Banking Supervision. So they are mostly famous for the capital adequacy ratio. So all the central banks they will follow the Basel Committee's recommendation, and they actually regularly meet to and they give actually a guidance or standards for the prudential operation of the banking industry to make sure the system is safe and efficient. And all the central banks of different countries they will ensure that they implement the Basel Committee's recommendation, for example, the capital adequacy ratio and any other reserve requirement. And then we have Islamic Financial Services Board, which is based in Kuala Lumpur. So we can say this IFSB is the Basel Committee for Islamic financial institutions, because Basel Committee is for conventional banks, and sometimes they make certain rules and regulation which may not be or which might be contradictory to Islamic principles, or which would be difficult to Islamic financial institutions. So what the IFSB will do, they will liaise with the Basel Committee, where Islamic financial institutions they need a different treatment, or where Islamic Financial Services Board (IFSB) they will study Basel Committee's rules and regulation, and they will come out with some extra recommendations for Islamic financial institutions. And then we have Malaysian Accounting Standard Board that gives accounting standard. So Islamic financial institutions in Malaysia they need to follow Malaysian Financial Accounting Standard (MFRS), okay, which is issued by Malaysian Accounting Standard Board, which is compulsory. Of course, they need to follow the Sharia standard along with the Malaysian Accounting Standard Board. And then we just talk about AOFI, Accounting and Auditing Organization for Islamic Financial Institutions. So they are the pioneer of Islamic finance based in Bahrain, which develop standards for accounting and auditing for all the contracts of Islamic finance, let's say Mudaraba, Musharaka financing. They have standards, and also they sometimes revise their standards. Another important body is General Council for Islamic Banks and Financial Institutions, (CBAFI), which is based uh, in Bahrain. Okay, so they also they actually represent Islamic financial institutions in the Muslim countries, because they are under the OIC, Organization of Islamic Cooperation. So they will hold awareness programs, seminars, along with they will issue some certificate programs, professional degrees, and also they will collaborate with the Basel Committee and other international organizations to represent Islamic financial institutions or Islamic banks in the world. And finally, we have in Malaysia Association of Islamic Banking Institutions in Malaysia. We call IBIM. So this IBIM is the association of all the Islamic banks in Malaysia. As we see, you know that the conventional banks, they also have, I think, Association of Banking Institutions in Malaysia. So for Islamic Bank, we have the IBIM, Association of Islamic Banking Institutions. So they conduct research, timely research uh, on Islamic financial institutions. They also talk on behalf of any issues related to, on behalf of the Islamic financial institutions to the regulator like Bank Negara. So they are also conduct. Sometimes they have seminars and to discuss the current issues related to Islamic banks in Malaysia. And all these places mentioned here actually, maybe other than the Basel Committee, you have a good opportunity to do internship, okay, especially for Islamic finance students. And then I would recommend to for you to take some certificate course like AUFI. Okay, they have two certificate course and you can take the exam online. So this one is very important if anybody wants to work in the Middle East. They Islamic banks, they require all the employees, they should have this certificate, I think, certificate of Sharia advisor. So which is very important for Malaysian graduates if they like to enter the Middle East market. So with that, so that's all on this topic. So with that, I thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.